Hello everyone, welcome back. We are still at income tax. Now we will look at another portion of income tax, which is property income. Now remember, we will only look at the property income from the perspective of when we let the property to our tenants. We will not look at the from the perspective of when we sell the property, because when we are selling the property, that is capital tax on the profit when we sell the property. We will look at the capital taxes later when we move to our capital gains tax. Right now, in this portion, in this lecture, what we do is when we have a property and we let to our tenants, so they will pay us rent in back. And likewise, we can give a full home, or we can just let out one single room if we want. In both cases, what we will be paid is rent from our tenants. So that will be one source of our income in shape of rent. Now on the other hand, we will be doing some expenses as well. While deducting the expenses, we can only deduct the revenue expense, so we will not deduct the capital expenses, and there are some other restrictions as well while deducting the expenses. We'll see later when we move to our notes in a minute. Right? So what would happen is that first we will take the rent, then we'll deduct different expenses as well. Now, although apparently there is only one source of income when we talk about the property income, which is rent. Now, on top of rent, what we get is something called premium. Now, premium is the amount which tenant pays you in advance, which is not refundable, but they pay you just because they want to have that property. That property is at a so special place that they are very desperate to have that property. Say for example, if we talk about the UK, if the property is in central London, then they will be very, very desperate to have that property, so they will be willing to pay more as a premium because they want to have the property. So that's why that premium will not be refundable. However, they will be paying you just to secure the property on the lease. Right? So what would happen is that they will have the property for whatever years they want, say for example 20 years or 30 years. Right? So it will not be a short-term rental agreement. Obviously, if it is just for a couple of years, then they will not be willing to pay you 20 grand or 50 grand, whatever, as premium. So when we talk about the premium, it will be they will pay you the premium, but they will have the property for long-term lease agreement. Now in the property income, when we talk about the leases, it is not IAS 17 accounting leases, it is something called long-term rental agreement. So whenever we see leases in ACCA F6 and P6, leases simply means a long-term rental agreement. Right, so our sources of income, if we talk about in the property income, one is the rental income, another one is premium. So we will do on the board as well now. So what we take is in the income section, we'll take the rent first. So if we talk about the income, so first we take rent, and then also we'll add premium into it. Right, so these will be our sources of income. Out of that, what we deduct is expenses. So whatever our expenses will be, we'll be deducting all of our expenses from this figure, and final figure, this is going to be our property income. And this property income figure, this will go into our income tax pro forma. Remember the income tax pro forma, where we divide the income into three different sections. One is non-savings, then savings, and finally from dividends, finally the dividend. Now this property income will go into the non-saving section of income tax pro forma. All right. Now, although we know how to, rent will be given to you in the question anyway, so there is no need to calculate the rent. So we can just pick up from the question. But if we talk about the premium, there is a special way to calculate the premium. So in order to calculate the premium, we'll take the premium amount which will be given to us in the question. So we'll take the premium. Then what we deduct is a standard fraction, which is premium, which is the same amount which we have mentioned earlier here. So it will be same amount into n minus 1 and multiplied by 2%. So this figure will be deducted out of this one, and net amount, this figure is going to be our premium, and this figure will go here. So it will be added in the rent. Alright, so that is a way to calculate premium. So first we take the rent, then we add premium into it, and we'll deduct different expenses. And when we talk about the expenses here, we can only deduct the revenue expense, so we cannot deduct the capital expenses. I'll just share the screen with you now, and we will read the notes from our lecture notes. So we are at chapter number 6, page number 15, as you can see on your screen, property income. So first of all, we take the income, and in income section we take rent and we add premium into it. So when we talk about the rent, it is on the accrual basis, it is not on the cash basis. So regardless of when the cash is paid, we will always write the rent on accruals basis, so whenever it is due. Then we add premium into it, and we'll deduct the expenses again on the accruals basis, all of the expenses. And the list of expenses which are given in the notes are repairs and maintenance, advertisement, then agent's fee, insurance, water rates, bad debts, council tax, redecoration, and interest paid on a loan for partnership. There will be some other revenue expenses as well which we can deduct. And a new syllabus area which is added in this chapter is replacement of furniture relief, sometimes known as replacement of domestic items relief as well. Now this new item, replacement of furniture relief, it is replaced. So it has replaced the old wear and tear allowance. If you are retaking this exam, you might remember from your previous sitting or previous studying of F6 that there was something called wear and tear allowance, which was 10%. Now wear and tear allowance is no longer in our syllabus. This new thing is added, which is replacement of furniture relief. So deduct this expense as well, and the net amount is going to be our either profit or loss. Say for example, if there is a loss here, a property loss, then it will be carried forward to set off against the future property income. Alright, so if there is, we'll carry it forward to our future years. So if there is a property profit in future years, then that property profit will be reduced by this loss, so we will have to pay less tax in future. Right, so we will see losses later in a couple of lectures. Then you will understand this point in a clear way. Now, as it says, capital expenses are not allowed as property expenses, and even depreciation is not allowed as well. So if there is a property loss, it can be carried forward to set off against the property income of the future year. Now, this new thing, which is replacement of furniture relief, it has recently been added. Now, like the name says, replacement of furniture. Now, it is only given on the replacement. So if you have bought a new thing, you are not replacing anything, you just have bought a new thing. So when you've bought a new thing, it will not be available on that. It will only be available on the replacement. So whenever you have replaced an asset, whenever you have replaced a furniture, it will only be available then. So if you have bought new furniture, it will not be available. Now, for example, if you have replaced the old furniture, so obviously when you are going to replace that old furniture, you will take that furniture and you will go to the market and you will sell that furniture, obviously. So the previous old furniture which you sell in the market, so that will also give you some money as well. So the new furniture which you bought, that's cost of new furniture will be reduced by the proceeds of the old furniture. All right, so that is a way to calculate the replacement of furniture relief. And it says then does not apply on the furnished holiday letting in the notes. Now, furnished holiday letting we will see in a minute, but under the furnished holiday letting, replacement of furniture relief will not be allowed. However, the capital allowances will be available. Capital allowances simply means depreciation of taxation. So we will see later in a minute. So initial cost of buying the new furniture is not deductible. Only the cost of replacement is deductible. Relief will be reduced by the proceeds of old assets, as I said. So when you sold the old asset, it will give you some money as well. So the cost of new asset will be reduced by the proceeds of the old asset. Now, new and old asset, another condition is that new and old asset must be of the same category in order to get the relief. And it does not apply on the furnished holiday letting, FHL it says, because there is something called capital allowances is available on furnished holiday lettings. On the next page is the same thing which I have shown you on the board, how to calculate premium on the leases. So what we do is we take the premium and we deduct premium into n minus 1 multiplied by 2%. Now the only thing which I did not mention you, that what does n means here. Now n in this formula, n means that number of years. So whatever the number of years this lease has been granted for, so we'll deduct we will put the number of years here. Now in here in the notes I've given you a small example. Say for example, if a landlord has given a lease for 20 years to Mr. B, and the premium was paid of £20,000. So how to calculate the premium? So we'll take premium amount, which is £20,000, then we deduct this formula, which is premium into n minus 1. So n here means 20 because it is for 20 years. So n 20 minus 1, so the answer as shown in the notes is 12,400. So that is the way to calculate premium. Next bit is a rental room relief. So as I said, property income can be earned in two different ways. One is that either you let the whole property to the tenants, other ways to just let a single room. So for example, if you have a big house and you have extra room into it, in that house, and you want to let that house, let that room to someone outside your family, they will be paying you some rent. So that will be a rental income as well. Now, when it comes to rental room relief, there are two ways to calculate rental room relief. One is the ordinary way. So ordinary way simply means where you take the rent on accruals basis. Ordinary way simply means that you take the rent on accruals basis, and you will deduct revenue expenses on accrual basis as well. So that is ordinary way. Then there's something called alternative way. Alternative way is sometimes known as a rental room relief way as well. So what would happen here is you cannot deduct the expenses under this way, under this method. So we'll take the rent only, but we can deduct exemption, which is £7,500 for our current tax year. Now, for example, if the property is jointly owned, then we'll take half of it instead of £7,500. Excuse me. So under the alternative method, we cannot deduct the expenses. So a taxpayer may choose to calculate taxable income in the ordinary way, ignoring the rental room relief. So it's up to the taxpayer, whichever way he may choose, he can choose. However, whichever way he chooses, say for example, if he chooses the rental room relief way, then he must inform HMRC by 31st January 2019, which is 22 months after the end of tax year. So after end of the tax year, 22 months after the end of tax year, you must inform by this date. Alright, so this date, 31st January 2019, this is for our current tax year, which ends on the 5th of April 2017. Now if you come on this last page of this chapter, page number 17 please. Excuse me. So that is a furnished holiday letting, FHL. Now furnished holiday letting is another portion of property income. So what happens is that you are a rich person, although you have a house in city in London, but you also have a one house, say in somewhere in Weymouth or Glasgow or Edinburgh by the beach. So what happens is that that house is called furnished holiday letting if certain conditions are fulfilled. The first condition obviously is that it must be on the holiday spot, so it cannot be in the middle of the city. So if you have a house in central London or somewhere in the city in the city of London, it will not be considered as a furnished holiday letting because it is not on the holiday spot. So it must be on the holiday spot. That is the first condition. And obviously another condition is that it must be let on the commercial basis, so your motive will be to make profit. Alright, so what are other conditions? So first one, it says that letting must be, so first four, which is from A to D, these are the conditions. If you want to write down, please make sure you do that. These are the conditions, and other three from 1 to 3, these are the benefits. So why shall someone have the furnished holiday letting? are there any benefits or not. So these are the benefits. So if you want to write down, if you have the notes in the hard copy, please make sure you write down, or I will encourage you not to print the notes, obviously, because these are not environment friendly. You should care about the environment before printing. That's why I'm using it on the iPad, because otherwise I would have got the print. Right, so first one, it says the letting must be furnished accommodation made on the commercial basis. So obviously that it will be furnished accommodation, and it will be on the on the commercial basis. You will be letting it to make the profit. So your main aim will be to make the profit. Then this property must be let for 210 days during the year. So it must be available for letting for 210 days during the year. Then the next one says it must actually be let half of those days. Half of what days? 210. So half of 210 is 105 days. So it must actually be let to general public for 105 days. So first one, it says that it must be available for letting for 210 days, and then the next one, it says it must be let to generally to the public for half of those days. So it must be actually it must actually be let for 105 days. And the last condition is that it must not be let to the same person for for longer term occupation, which is 31 days. So you cannot let the property consecutively to the same person for 31 days or more than that. All right. Now, what are the benefits? Now let's look at the benefits. Capital allowances will be available on the furniture instead of replacement of furniture relief. As I said earlier when we were reading replacement of furniture relief, that it will not be available on the furnished holiday letting. So capital allowances will be available on the furnished holiday letting. That is one benefit. The next benefit is that income will qualify as relevant earnings for pension contribution purposes. Remember, we studied pensions in a couple of lectures ago in pension chapter number 5. So what happened is that income qualifying for pension relief purposes was higher of £3,600 and UK relevant earnings. Please go back to chapter number 5 and you can check it there. So it was higher of £3,600 and UK relevant earnings. Under the UK relevant earnings, one of the component was that income from furnished holiday letting. So that is another benefit as well, that income will qualify as relevant earnings for pension contribution purposes. Next one says that capital gains deferral reliefs will be available. We'll study these when we move to our capital gains tax. So just remember these as another benefit as well for now, but when we study the capital gains tax, then you will understand this rule in a better way. Alright, if a taxpayer has more than one letting, if a taxpayer has more than one letting of which some are furnished holiday letting while some are not, then drop two profit and loss accounts if they are two separate property businesses. This is so that profit and loss treated as trade profits can be identified. Right? So that is end of our chapter. And that is end of our chapter of property income. We will do a little question on that as well in the next video or the video after that, which is a past exam paper, I think, which is one of the questions from the exam kit. I will tell you some exam tips as well in that. Alright, so that is income tax question. I'll see you in the next video then. Thank you and goodbye.